Perfect. So, thank you, first of all, everyone, for joining the session today. And we did want to welcome you. Kristen, if we can go to the next slide, we can. I just want to welcome you. So, thanks for taking your first step in your journey to building wealth through real estate. Your presence here is an important step toward achieving financial freedom and independence, and that's why we're all here. This is a goal even of the folks who are on the call who are presenting. So I am going to introduce everyone who's on the call, and I will allow Leo at the time that he will be presenting to introduce himself as well. But let's get into who's on the call today presenting. So Kristen Haynes is right next to me, and she and I are part of the Les Maisons partner team. And the Les Maisons partner team, we're a realty group that we cover the Metro Atlanta and Middle Georgia. There we are right there. And we're dedicated to exceptional client service and helping everyone to achieve their wealth building dreams through buying, selling, and investing in real estate. And our goal for today, I think we got to switch back to the last slide. Sorry about that, Kristen. But our goal for today is really to answer any of your questions and also to talk about how we can empower each of you with the knowledge and resources you need to make an informed decision for real estate investments. And we're going to explore some of the innovative real estate strategies that we've got going on. And we are very, very pleased to be joined by Leonardo Noriega, who's on the phone. He is part of Nexa Mortgage and honestly is just a fountain of information when it comes to the mortgage industry. He is just a depth of knowledge and expertise, and he has 24 years plus in this business. So when he talks about mortgage and real estate strategies, he knows exactly what he's talking about. So we will have him come in towards the end of the session, but let's get started with a little bit about why would you consider real estate for some of your wealth building goals? And I wanted to give a couple of, you can see on the slides, a few of the facts that we have already, but 32% of buyers in 2023 were first-time homeowners. So if you have not purchased a home just yet for your primary residence, there are a wealth of people who are purchasing homes and as buyers in 2023. And there's so much room for first-time home buyers to take advantage of that purchase power. Also, among current homeowners, 14% used a first-time homebuyer grant or an assistance program to help with their down payment and closing costs for their first home. So there are programs out there, and Leo will get a little bit more into that and what the criterias are for certain profiles. So, but there's money out there, and we always say if you can use other people's money, go ahead and do it in order to try and realize your real estate goals. The US housing market is now worth a record value of $47 trillion. There's a lot of opportunity in the housing market. And only 5% of Americans own more than one home, and we're considered that vacation home and income producing home. So real estate is one of those consistent investment opportunities. So while markets fluctuate up and down, real estate, it is very consistent, and a lot of people decide to use it in order to achieve a lot of their goals. So the next slide, if you could. So wanted to give you a couple of ways of how to shape your plan. So the first thing that we want to do is define your goal. So ask yourself these questions. Do you already own a primary residence? So for all those who are on the call who own a primary residence, all of you who are seeing this on demand, If you if you don't own a primary residence, what kind of, how will it fit into your wealth generation goal? And if you currently own one, how are you going to fund your investment options? Will you be using that primary residence to fund it as well? Are you interested in long-term or short-term property investments? And we'll get a little bit more into what that means as far as long-term and short-term, but there are different opportunities depending on what your goal is, whether it is to fix and flip or whether it is to hold your investment opportunity, your investment properties. And then important, review your current financial and credit status. This is going to be important. So Leo's going to go into if you're going to use, if you're self-employed and you want to use your business, that is one of the different opportunities you could use. But it's really important for you to know where you sit financially and credit wise to see what your options are and which lane you might want to go down, because there are a lot of different ways of getting, especially investment opportunities. And check and create a plan based on your yearly goal, so annual, year over year, in 5 years, and in 10 years, where you want to be with your real estate investments. And then we're going to go on to the next step, which is target your approach. So we talked a little bit about primary residence versus investment home. So the primary residence being that main residence that you live in most of the year. And this is usually what people use as the foundation of their portfolio, their real estate portfolio. And then investment homes, we talked long-term and short-term. It can, in long-term, you can lease out your investment home and you can keep it, and or you can short-term flip it and try to move on to the next one, or you can use a multi-purpose home. A lot of people do that. Leah's going to delve into that. This is one of the most innovative strategies. If you use a multi-unit home and you use one of the units or the spaces as your primary residence, you can use the other spaces, the other units for income producing opportunities. So that's going to be a really great one, I think, that a lot of people are going to be interested in. So step number 3, show me the money. So there's a lot of different ways to fund these property purchases. You can use cash. If you have that money, great. Most people don't have the full amount to purchase additional properties outright. So a lot of people choose to use financing as far as mortgage. So that's a traditional mortgage financing. Leo is going to go and talk about that, with down payment assistance, potentially grants, a lot of different ways of getting that money and being able to finance it through traditional aspects. And then there's hard money, which is a short-term or bridge loan for investment properties. These are some of the financing opportunities that people use a lot of times as seasoned investors. And then you can always augment your financing with gift money or crowdsourcing. And so we just need to be able to have a paper trail, obviously, of where it's coming from. But a lot of people lean in to their family, their friends, in order to try to finance and augment how they're financing. So the final one that we want to do is getting into the details. So these are some important factors that are going to impact all of your decision making. You're going to want to think about where the properties are located. So either the primary home or the investment home, location is king in real estate. So we really want to make sure that we're delving in and knowing where that property is located and some of the aspects and surroundings of the location of the property, not just the neighborhood, not just the city, but where it is located specifically on the street, everything. The income producing properties. What is your expected cash flow? This is very, very important. It doesn't matter if you're a first-time investor or seasoned investor. This is how we determine a lot. Expected cash flows. That's also how we determine for certain program types that investors can use as far as mortgaging. some of the cost. So you have to think about your property taxes, how much it's going to cost to maintain the home. That goes right into the condition and the age of the property, which is another factor. So you're going to have to think ahead. How much is this going to cost me on a yearly basis to maintain? And the property valuation. What is the property considered now? That again, condition and age of the property are huge factors, aspects of that. And then, of course, your return on investment. Any investor is going to tell you that ROI is key. So I'm going to go right into the next, which is the home buying process. And at this point, I'm going to turn it over to Kristen. She's going to talk about the home buying process. So for those of you who have already gone through it, this may be something that you learned, even something new as far as a home buying process. We wanted to take you through what's going on in 2024.
Thank you, Nasia, for the handoff. And I will say, just to add to that, even if you have purchased a home before, I've had many clients who have purchased homes before in the past, maybe in another state. Things are different here in Georgia. So it's very, important to kind of go over this process and who the key players are in this process as well. And as some of you know, some things have changed a little bit in the industry over the past year. So it's good to have kind of a reintroduction to the process. So let's get started. I'd like to say there are about 12 steps in this process. So to make it kind of manageable for people. So the first thing that we always recommend is that you talk to a reputable lender. They'll look at your credit, your income history, your assets, all that good stuff, in order to get a pre-approval out for you. And I know a lot of people are very excited about the home buying process. They want to go see homes right away. But it's very important that you, in that planning process, set a budget and then talk to that lender so that you are, within that budget that you want to stay within. I tell clients all the time, there's nothing worse than going out to see homes, falling in love with a home, and then, seeing that it's outside of your budget. No other home is going to compete. So that's why that is the most important first step. Next, that's where we come in, either before or after. Meet with a realtor. And so we're basically going to have a consultation prior to going out to see homes. And we're going to talk about what your needs are, what your goals are. And we're going to go over this home buying process in a lot more details, ask you questions. It usually takes about an hour. It's a very in-depth, detailed conversation about the process that we do not skip. Next, the part that everyone loves is the house hunting. So we will set you up on an automatic MLS search where you're able to save favorite homes, send us homes, that sort of thing. Next, so we have been looking at homes. You found the perfect home for you. We are now going to make an offer. And again, before we make an offer, there's still a conversation to be had. We will run comps in the system to make sure that the offer price that you are putting on that contract is in line with what's currently going on in the market. We want to make sure you have an offer in that, is in your best interest, but also one that is competitive. So you're going to, go over the disclosures for the property. We're going to discuss where you want to go in with your offer. And we're also, like I said, with the terms of the offer price and other details, helping you come up with a strategy so that you can make the most competitive offer. So next we get to negotiating terms. And basically you're submitting the offer, and the seller may not accept your offer. They may want to counter some of the terms in the offer as presented, but they may accept it. That's what we love. We love that. Or they may reject your offer offhand. So those are the three things that could happen after you submit an offer. So in the case that your offer was accepted, we are now under contract. Hooray. Very happy, very excited about that. So at this point in the process, the showings are stopped and we are not making really any more additional offers. Um, Earnest money is accepted. And we're going to talk a little bit, we'll talk about that in your consultation, what that means. And usually within 3 days or so, we're sending in earnest money. It's just a fair, good faith money. The next important step in the process, and I feel like this is the most pivotal step of the process, in our contracts, in your offer, you negotiated a due diligence period or an inspection period where you can have the property evaluated to make sure this is a home that you want to move forward with. So your inspector will be looking at the structural and mechanical um, operations of the major systems. You can also get additional tests for, radon or mold or termite inspections. This is your time basically to do your due diligence. That's, the very, very, very pivotal part. Next is the inspection negotiations. So after there's the inspection period, there may be repairs that we're going to request that the seller address. And so we're going to write that down and we're going to negotiate which ones they will repair and which ones they might offer closing credit for. So there are a lot of different ways that we negotiate after in this negotiation inspection process. So once we get through that process, I love to tell the home buyer that, the kind of talking constantly with your realtor will start to kind of lessen a little bit. We're still in constant contact with each other and checking in and giving updates, but kind of the frequency of the communication kind of quiets again a little bit. And this is really where your lender and the closing attorney take on a much larger role in the process of moving us along. So one of those next steps is the appraisal. So your lender will work with you directly to make sure the appraisal is ordered and paid for. And basically the appraisal is just there to make sure what you offered on the price is actually what the home is valued for. And next, the mortgage. Again, you are going to be close and very tight with your mortgage lender all throughout the process, but especially during this time. So they are going to make sure that they get you to that approval, clear to close process. So we're going to, they're going to ask for different paperwork, different things and documents, and you want to make sure that you're on top of things and that you're providing them with their information as soon as possible because you do not want anything to delay your approval process. Also during this time, they're going to ask you about homeowner insurance. As your realtor, you're going to ask you about obtaining homeowner insurance as well. Pre-closing. So we're in the home stretch. You're getting that clear to close from the lender, basically saying, yes, you are approved and we are ready to get to the closing table. So this is the time where you're, arranging to set up utilities, prepare for the closing dates, schedule movers, that sort of thing. And you will get, no more than 3 days before closing, no later than 3 days before closing, a disclosure from your lender, basically detailing all the money that you will need to contribute to at closing. So it's all detailed and itemized, and this is something that you get to review prior to the closing table. Once everything is good, we schedule the closing, during this time. We are going to have a final walkthrough within 24 hours of closing, either the evening before. If it's a vacant home, usually we'll do the day before. a lot of times, the morning of closing, we will do a final walkthrough of the property. It's very important because we want to make sure that the property is in the condition that we agreed that it will be in upon closing. The seller has moved off all of their property, all of their belongings, and it is ready for you to move in. If there are any issues, we want to make sure they are addressed before you sign that document, because once you sign, it is your home. So we usually have, in-person closings where you will sign all of your documents, you will get your keys, and now it's time to celebrate. So that's the home buying process in a nutshell. So now I would gladly like to turn it over to Mr. Leo Noriega to talk about the financing process.
Yes, yes, yes. And greetings to everyone that's on the phone call today with us. Thank you, Nasia and Kirsten, of course, for you guys including me in this presentation today. And actually, being able to pass on some of the tools, the resources, and of course, the experience that we have, in total as a team. So I appreciate you guys for the short intro. Initially, just wanted to go ahead and introduce myself also formally here on the presentation to everyone that's on the phone call. So on the lender side, I've been in this industry now for 24 years, basically doing the same thing as what's considered a licensed, I'm actually an interstate, multi-state licensed mortgage loan officer, covering pretty much the entire country in 48 states on what's considered the investment side of residential and commercial financing, and then on what's considered the primary or primary home financing or second home financing. I'm actually licensed in the state of Georgia, Florida, Texas, Tennessee, and also the state of Utah currently. I've been doing this for 24 years primarily because I have a passion for what I do. This is something that I would say is probably a second love to me next to both of my children, just because my children are first love to me, in life in general. But I wake up and go to sleep basically doing what I do for a living, and that's why I'm here, and that's why I focus primarily on making sure that not only do I assist my clients with getting into their first home, second home, or working on building a portfolio for investment purposes and long-term wealth, but also make sure that they understand everything that they're doing step by step. So yeah, if we can go into the next slide, that would be awesome. Okay, so now before I go into this first slide, I want to make sure that everyone that is listening on this call and a part of this presentation now or in the future, that they understand the concept and the strategy of what we call on this side of the business primarily, what we call purchasing money. Purchasing money and being able to leverage and collateralize real estate for what we consider a maximization in building wealth through equity in all pieces of real estate that you own, short term and long term, obviously, depending on what your goals are. And so, what I'm going to talk about primarily is that concept and how you can utilize that concept to not only start your wealth, but also make sure that it is a long lasting, long term, lifelong, and even I like to say even a legacy that you would be able to pass on long term to your children and even family members. It's just a wealth of information. And so on this first screen that we're looking at long term benefits of what real estate ownership is. We like to generalize the real estate ownership side just because there's so many different types of real estate that you can actually own, not only on the residential side, but then also on the commercial side, which is a little bit different, but again, the same goals and the same plans. First benefit that you're always going to have is going to be what's considered the equity building, which I parenthesize here as savings. And the reason why I use the word savings is because as you purchase real estate, depending on what market you're in when you actually purchase that real estate, that time frame is also very important for this aspect of it. You will be building and accumulating what's considered equity in every piece of real estate that you own. And that equity and savings that you actually build on that piece of real estate would equate to money that you have available for different purposes, which we'll also talk about in a future slide here shortly. Another benefit of this equity building would be the use of these funds for debt consolidation. I currently, in my entire career, have done refinances for um, homeowners that purchase their home using me to purchase their first property, second property, third, fourth, and fifth. And once we're in that second property, we're usually consolidating all the consumer debt that they have. So this would be paying off any car loans, credit cards, personal loans, and even student loans that you have on your credit report file. The third point here is the home improvement use. A lot of people when they purchase their first home primarily, want to purchase that dream home. That's usually 95% of the time, that's usually what we're looking to do when we purchase that first home. But I like to tell people a lot of times is that a home is kind of like a Lego. It's kind of like a Lego piece, and I like to use that as an example because you don't necessarily have to purchase your first home and it be your dream home with everything that you wanted and aspired for in it. A lot of times you can purchase a first home and then slowly transform that home by home improvements, by doing additions, bedrooms, new kitchen, new bathroom, so on and so forth. And those improvements actually equate to more equity building as well. The fourth point here is interest deduction on tax purposes. A lot of people don't know that every cost that's included in the purchase transaction of that piece of real estate, which is considered what we consider closing cost on every transaction, is tax deductible at the end of the year. So when you go and file your taxes, you're actually able to deduct those costs as expenses and deductions on your tax returns. The fifth point here is college funding. A lot of people, again, don't realize that this equity could be used to fund the college for any children that you may have now and in the future. These are funds that would become what's considered liquid funds if you decide to use them in cash for any other investment, such as college funding. Sixth point here is the reinvestment for additional income earning properties. This is a huge one. Once you own your first piece of real estate, or even if you are a first time home buyer and you're looking to actually create an additional income from the real estate you own, this is where this benefit is going to come in. You're able to use that same equity a lot of times and move it from your first home to your second home and then to your third home and so on and so forth. And then the last bullet point here is the long-term retirement funding. I also do what's called reverse mortgages because through the mortgage financing services I offer, I'm able to do pretty much every type of mortgage financing using real estate as collateral, of course. And a lot of times don't consider the fact that, with all the changes that we've been having, especially on the federal side with, Social Security and disability income slowly diminishing right now more than ever, you are able to use the equity in your home to actually fund your own long-term retirement. And again, these are qualification criterias, but it's something to consider as a benefit long-term. So we can get to the next slide, sorry. So this next slide here is key. I like to use these 4 slides that we're going to go through as what I call pretty much golden nuggets, just because this is the information you need to have in your hands to be able to start, this journey, but more importantly, start it correctly. And so this next slide is actually going to give you a list of the types of properties that you guys can, finance and own. The first one, which is the one that most people know and understand of, is obviously a single family dwelling, which would be, any home, 3 bedroom, 2 bedroom, 1 bedroom. I've done homes up to 1 bedroom. Second one is a condominium or an apartment, because there are states and places that actually consider them apartments instead of condominiums. The third one is a townhome, which for the most part are 1 to 2 bedrooms. Sometimes there's three. I'm sorry, 1 to 2 floors. Sometimes there's 3 floors in these two. Um, the fourth one is a manufactured home. Manufactured homes are, in my opinion, a great secret out there. Within manufactured homes, not only do you have manufactured home prefab homes that you actually buy and design at the factory level, and then basically have transported over to your piece of land, and then put on a foundation from there. But you also have modular homes. Modular homes are a part of the manufactured home financing possibility. And then you have duplex, you have triplex, you have quadruplexes, which are basically row houses. They're all usually in one place, in one setting, and they're side to side or front and back. Yeah, and then you have the multifamily option, which is 1 to 4 units in one actual piece of property. The multifamily option is a very, very big and very popular option right now, for the most part, because you can purchase a multifamily piece of property, live in one of the units as a primary residence, and then you are able to actually utilize the other 3 units as long-term leases or even short-term leases for rental income purposes. Um, and that could be a first-time home buyer, and that could also be a repeated buyer. So this is someone that currently owns a primary residence, but maybe looking to, own more property after that. Um, the uses here obviously are primary residence, investment property, short-term, long-term, second home, vacation homes, which is what I just spoke of. So we can go to that next screen here. This slide here is a slide that I like to include on every presentation that I do. And this is whether it's a first-time home buyer presentation, just a general real estate ownership presentation, and even an investment presentation. Just because it's actually a visual illustration of what your numbers will look like on any particular type of investment. And I'm gonna go ahead and explain the chart here just so you guys understand it and are clear with it. On the left-hand side of this payment chart, you're gonna have the first tab section, which is what your yearly income would consist of. And on the chart, we have it from $40,000 a year all the way down to $100,000 a year. In the middle section, we have what your maximum mortgage payment would be, qualification purposes, based on that income, based on that annual income. And then on the right hand side, we actually have what you could afford as a purchase price, and then right next to it, where it says P, it would be your purchase price, and when we have the letters LA at the end, it would be your loan amount for each one of those purchase prices. Over on the assumption box, which is where we want to start, we actually have a box where we are listing the interest rate that we're using to come up with these numbers here. What's considered a 45% debt to income ratio for qualification purposes. We're calculating a 4% closing cost percentage on each one of these transactions, and a $500 a month mortgage insurance and escrow account that's also included in your mortgage payment. And the assumption here is based off of an FHA loan, which can finance up to 96.5% of the purchase price. So I'm just going to go through the first column and then the second column. Obviously, everything in between you guys can put together. But on the first column, if your yearly income is at least $40,000 a year, you would be able to qualify for up to a $200,000 purchase price. your loan amount based off of, again, an FHA loan at 96.5% financing would be $196,377. And that would equate to a mortgage payment of $1,566.51. That mortgage payment that you see there, I want to stress, it's what we call the principal, interest, taxes, and insurance payment. So that payment and mortgage insurance. So that payment would actually include everything in there. Okay, so there's nothing additional to that payment that you see there. Now, going all the way down to the $100,000 column. So once again, if your annual income was at least $100,000, you could afford up to, not up to really in this case, and I'll explain why. But in my illustration, I have a purchase price of $500,000, and then you have a maximum loan amount, 96.5% at $490,043, with a total mortgage payment of $3,132.49. And once again, that payment is a principal, interest, taxes, insurance, and mortgage insurance payment. So that's everything included, nothing additional. Now, what I want to stress in this last column here with the $100,000 a year income is the reason I actually stopped the chart at the $100,000 income with a maximum price of $500,000 is because for FHA financing, we have what's considered maximum loan amounts that we could go up to on the financing side that are dependent on the county in which you purchase that property in. Currently, in the current market, the general traditional maximum loan amount in the country is $746,000. But again, that's going to vary by county in where you purchase the property. And so what I wanted to do is I wanted to maximize it at a $500,000 purchase price because of that. But technically speaking, someone that makes $100,000 a year could actually afford possibly up to a $700,000 purchase price. So I just wanted to stress that point out, just because you are able to get a little bit more purchase price power at $100,000 on an income, but I maximized the chart because of the maximum loan amounts. We can go to the next slide here. So I believe this is the last slide that we have here on the presentation. We don't want to overwhelm you guys with obviously too much details on the information we're handing out. We just really want to give you guys a visual and empower you so that, you know, you may make a decision to take the next step here. So the last slide here is just going to give you a quick rundown on the types of borrowers that basically I work with every day. For qualification purposes on everything that we've talked about so far. First one is going to be, you know, your general W-2 employee, which we consider a wage earner. This is someone that's usually paid on an hourly wage. And at the end of the year, they receive a W-2 for them to be able to file for their income claim for taxes purposes. And then you also have a salary employee, which is obviously someone that receives a set salary from the time that they start their employment position to the time that they finish, also receiving a W-2 at the end of the year. The second one here, the second type of borrower is a big one, and it's also one that a lot of people don't understand or know that, you know, that could actually qualify. And that's what we consider the 1099 independent contractor employee. We have employees in this position, and we also have self-employed people in this position. We actually have both. The difference is that you are being paid on what's considered a 1099 form, and you have, for the most part, no tax deductions while you're earning an income through the fiscal year. At the end of the year, you file your 1099 same way that you would file a W-2. And then the third borrower type here is the self-employed borrower. This is a big one, just because a lot of people that are self-employed don't understand primarily two things. One, obviously, you know, because they're making a certain amount of money throughout the year, they're wanting to deduct and they're wanting to use as much expenses as they can when they go and file their income at the end of the year because of, you know, tax ramifications that could happen. a lot of these self-employed clients, we work with hand in hand to make sure that qualifications may be there depending on what their goals are. So I want to put that out there because it's very important that you understand that even though your income may not be suffice at the time of the application, that's something that could be worked on. And then second point is a lot of self-employed borrowers don't understand or know that they can actually use the business that they have to be able to acquire properties under the business name and not necessarily acquire these properties under their personal name. I do want to clarify with that point that you will be what's considered a personal guarantor on that loan application and then on that mortgage um, eventually, but you are able to close the purchase under the business name so long as you're a business owner in that particular business. That's a very big point. Next bullet point is the experienced real estate portfolio holder. So we have a lot of buyers that are seasoned and experienced investors that currently hold let's say 5 to 20 properties. I've seen them as much as 120 properties at a time, in which they've already built what they consider residual income, and of course build and establish a large amount of equity in each one of these properties. We're able to actually do blanketed refinance mortgages where we can extract money from each one of these properties, lump them up into one loan, and then they can use that money to further extend their portfolio and purchase more property, or even use it for new construction, which is something that I'm doing a lot right now with a lot of seasoned investors. And then the last bullet point here is going to be retired liquid assets for borrowers. Retired liquid assets for borrowers. So what we mean by retired liquid assets for borrowers is, as I mentioned before, you if you have established a certain amount of liquid assets, either through real estate or any other channels of employment that you may have had, and you have a certain amount of money that would be considered liquid in any bank account, whether it's a 401k, a retirement account, a CD, anywhere the funds are sitting, that they could be liquidized to be able to use as actual income in this case for you to qualify for a purchase of a piece of real estate. The caveat to this last borrower is that if the property that you're purchasing is priced at $500,000, okay, then you have to have at least $500,000 sitting in one of these accounts that could be liquidized at any point in time. And that's more or less how we qualify that final type of borrower. We can go to the next slide.
Leo, could I just jump in for 1 second and could we just go back to the last slide? And
Yep.
I know I've had so many questions about this. Kristen can attest, we get this all the time. There are two specific mortgage products that we get the most questions on, especially with people who are starting out on their real estate journey, and then the other one, people who are trying to expand their portfolio. If you could talk quickly, and and as you said, we're not trying to go into every single detail, but if you could talk
Yeah.
really quickly about, because I think they're very, very innovative, the DSCR loan product, and then also
Yes.
for those who are looking at using a multifamily and living in one, and then going
Yeah.
ahead and having the other income producing properties, the ability to actually continuously do that, which we've seen people do very, very successfully, where they use that product over and over to to expand their portfolio.
Yes, of course, of course. So I'm gonna go ahead and go into the multifamily first, and then I'll go into the DSCR second. And I want to do that because of what I started, my side of the presentation with. Here is the exact way where you will be able to purchase money and be able to go from one property to 10 properties. Okay, and it's very simple to do this. There obviously are qualification criteria that you have to meet, but it's just a simple process. So I'll explain it. So if you decide that you are able to reside in a multi-unit property, which would once again be considered a property that would be 1 to 4 units. Right now, the maximum is 4 units. Um, I'm actually reading into them expanding this, which would be great, into a 7 unit. Um, and that may calm down the pipeline. But right now, 1 to 4 units, and you will reside in one of those 4 units as your primary dwelling, meaning this is where you're going to live full time in one of these 4 unit in one of these units in the 4 unit property, and you're going to go ahead and basically utilize the other 3 units as rental properties, more than likely long-term rental leases, so that you could, one, pay your mortgage, your actual mortgage payment on the property out of the rental income that you receive for the other 3 units, so that you don't actually have to have an out-of-pocket expense on your mortgage. And I'm seeing a lot of people even making money on top of making their mortgage payment, which is really what the goal should be, of course. Now, you have established at this point that you've purchased this first four unit property. You're living in one, you're earning an income on the other 3. And so now the criteria for you to be able to get into your second, your third, your fourth, and the fifth is very simple. It's the same process that you actually did when you purchased the first one. But the caveat is that you are required to occupy. This is the caveat. You're required to occupy that first property for at least 12 months from the time that you close on the purchase of that property as a primary residence. So 12 months is the caveat time. Once those 12 months come, then you are actually able to now purchase a new primary residence. You're able to actually purchase a second primary residence and obviously move into that new property as your primary residence, because once again, you're required to occupy it for another 12 months before you can move on to the third, the fourth, and the fifth. So again, the caveat is you have to occupy the property as your primary residence for at least 12 months from the time that you purchase it. Now, benefits on this, right, for qualification purposes, is that now that you have established a rental history and experience on that first property for the first 12 months, on those 3 units you weren't occupying, now you can actually occupy the fourth unit and put in a tenant into that fourth unit as well. And the great part of this is that we on the lender side are able to use that rental income, that total rental income that you're receiving from that first property, to qualify you for that second property you're purchasing, and repeat the process on the third, the fourth, the fifth, so on and so forth. So that is how you're able to go from your first, your second, your third, your fourth, and basically continue to build on using that strategy of purchasing, occupying, moving into the next one. Okay. Again, qualification criteria come into play, but that's the strategy there. Did you want to ask any questions on this one, or was that a good explanation before I go into the SER?
That was excellent because we get so many questions. Kristen can attest, people, they just want to be able to start, but they just don't know where. And along with that, people don't realize that they can also get renovation loans. So all of these
Yes,
are really important elements that people can use to build out their plan.
that's correct. And one thing that just popped in my head while you said that is I do want to mention that the required down payment, I left this part out, the required down payment on your second, your third, your fourth, fifth, and so on and so forth property using the strategy I just described is going to be 5%, a minimum of 5% down payment, obviously, plus closing costs, starting with the second, going into third, fourth, fifth properties. Okay. And the reason for that is because once you purchase your first property using the strategy we're describing, and you start with your second, you go into your second, your third, and your fourth, you're no longer considered a first time home buyer. You're now considered a repeated buyer. And so now you can't actually take advantage of that minimum down payment that you took advantage of on the first, which if you did an FHA loan would be 3.5% down payment. If you did a conventional loan would be 3% down payment. Last thing I'm going to mention on this one, just want to throw that in there, is that I am currently doing 100% financing on that first property you purchase, and we're talking multifamily right now, that same scenario. I can actually offer 100% financing on that first property because, again, you will be classified as a first-time home buyer. That you could actually take advantage of to acquire that first property. Now you no longer have a down payment requirement and you only bring closing costs. So I just want to throw that in there on that one. So now moving on to the DSCR product, the Nexa asked about. So first off, this is also a product I am doing literally every day right now in all the states that I service. Utah has been an incredible state for this product this entire year, really, and the same thing with Georgia as well. Florida has actually fallen off a bit because of all the expenses that have changed there, property taxes and insurance primarily. But so going into the DSCR loan, what's important to understand about the DSCR loan product is that we are basically qualifying the piece of real estate that you're purchasing for long-term investment purposes on the return of your money. To begin with, the DSCR stands for debt service real estate. That's what it stands for. And so the way the actual product works is first of all, I'm going to say that a first-time home buyer could actually do a DSCR loan. There's very minimal investors out there that offer it, but I have a couple that do. So I can actually do a first-time home buyer using the DSCR loan product. And to describe the qualification criteria, here are the 3 points. So what we're going to look at is what that piece of property could actually retain as a monthly rental income based on the market that it sits in. So I want to clarify this point. It's not what you are going to lease it for. You know, you may decide to put a tenant in there that's willing to pay you $3,000 a month, but the market actually indicates that the rent is $2,500 a month on that piece of real estate. We are going to use the $2,500 that the market indicates the property could be rented for. Anything over that and above, if you put a tenant in there for $3,000, that's just more income for you monthly, of course. But we're going to use the market rental price range. So that's the first point. Second point is, once we determine what your mortgage payment is going to be on that piece of real estate, obviously depending on your qualifications, then we're going to go ahead and divide. It's a very simple math problem. We're going to divide your mortgage payment into what that monthly market rental income is that we've determined. And that math problem is going to give us a percentage. That percentage that we get has to be a 1% or higher in order for us to determine that the market rent on that piece of real estate is going to be paid in full within the mortgage payment that you're qualifying for, or obviously exceed it. If it exceeds it, then now you're in what we consider a positive debt service ratio, which means that you're going to be making an income, obviously monthly, and it's what you want to do. So now that you've determined the debt service ratio, obviously all the other pieces of qualification come into play. One of the benefits of this product is that, again, since we're qualifying the piece of real estate, we're actually not qualifying you income-wise. We're qualifying the property income-wise. You will still go as any general mortgage or traditional mortgage. You will still have to qualify with with a minimum credit score, which by the way, right now is a 640 credit score or higher. You will have a down payment requirement for first time, what's considered a first time investor using the DSCR loan. Your minimum down payment is 20%, obviously plus closing costs. For anyone that's an experienced borrower using the DSCR loan product, we can actually do as little as 15% down payment plus closing costs. That 15% down payment will require a 740 credit score or higher, though. That's the kicker there. Okay. Um, and then the last point, last benefit with the DSCR loan is that there are no limitations on the amount of properties that you can actually acquire using this product. And the reason why is because once again, we are qualifying the property for long-term return of your income. We're not qualifying you, we're qualifying the property. As long as the property is able to pay itself and earn you a return on your income on a month-to-month basis and on an annual basis, then obviously you qualify for this product as long as you meet all the rest of the criteria that we spoke of with credit scores, so on and so forth. So that's the benefit there with this product. Again, is a product that I'm doing a lot of right now. I actually just closed. This was a Utah bar. I just closed as a first-time home buyer using the DSCR loan. She actually decided to purchase a multifamily property. That's what she did. But she decided to use the DSCR loan because she did have the down payment and everything else that was required. So those are the things that the DSCR loan consists of. Do you have any specific questions, maybe, Nasia, on that?
No, this is great. Honestly, I think this answers a lot of the questions that I know I have been asked even before this session. We get asked this all the time, but also I had a couple people who couldn't even make the session and said, make sure you ask this question. So we
Yeah.
want to make sure that we get all those questions in. That's what people were really, really interested in. It's just such an innovative, out of the box kind of product. And we want to make sure
Yeah.
that people are aware of it, that these are all within your scope. These are things that are not outside reality. It's not just, can be your dream forever. These are things that people can do concretely to take steps to start expanding or even to start their real estate portfolio.
Yes, definitely. And again, as you were speaking, I just thought of one last point here to throw in for the
You're
DS.
full of information. 24 years. This is gonna happen.
Yeah. Oh yeah. My head is like a toolbox, it wants to explode all the time. So the last thing I wanted to throw in there, I forgot to mention, is that with the DSCR loan product, you can also close this under your business name as well. So you're not required to just close under your personal name. And you can actually use a brand new business that you would have just, registered and established as an LLC, for example, literally just a day ago from the time that you apply for this product, and you can close under a business name as well.
Oh, thank you so much, Leo. This is amazing. I know, Kristen, we have the next slide being about questions. If anybody has questions, I know we already
Yeah.
addressed some of the questions that people had. But I also had a question as well about another strategy that we know personally a couple people have employed is that, and I don't know how much you've seen of this as well, Leo, because we'll close it out in another minute, but
Yeah.
people who have children who are going to college out of state, they have found that sometimes, especially in perhaps if they're going out of state in a place that may not be as expensive as the state that they're currently living in, they may decide to actually buy a condo or townhouse for their student to live in at that point. I'm not sure how you would address that as a second home, and then if the person eventually wanted to use that and leverage it as part of their portfolio going forward. Have you seen that?
Yeah, so I have seen it. I haven't actually done many of those, but I will tell you how it will be approached. Pretty simple. And basically what would happen at that point is, because, well, it depends. So I'll say this. If the parents don't currently own a home wherever their primary state of residence is, right? If they don't own a home. So let's say they're renting, because I've seen this a lot. If they're renting and they don't currently own a home where they're living, and now their child is actually going to college in a different state, then they can purchase that piece of real estate as a primary residence, and they would be able to actually potentially qualify as a first-time home buyer, because again, they don't own any piece of real estate. And if that piece of property is a multi-unit, again, up to 4 units, then we're in qualification criteria territory. Okay. Now, in the case that they own what the parents are currently residing in, and again, their child is going to be going to another state for school, then at that point, they're no longer considered a first-time home buyer. As I explained when I was going over the multifamily structure of how to go from 1 to 2 to 3 to 4, they're no longer a first-time home buyer. And so now what would have to happen is they would have to purchase that property as a second home or a vacation home. It's the same thing, second or vacation. And then the minimum down payment requirement does change there, just because, again, it's a second home. Um, and that minimum down payment requirement is now 10% down payment plus closing costs when you're purchasing a vacation home or a second home. The child can occupy that property, and if it's a multi-unit, the other units could be used for rental income purposes as well. But once again, the child could actually occupy one of those units, and they could live in that. Now, same as I explained before, with going into the first, the second, the third, and the fourth property structure, um, you're required to use that property as a second home or vacation home for at least 12 months. And then after that, you can actually transition that entire property, if you wanted to, into an investment property, which is what most people do. Or you can transition it into a primary. The parents may decide, you know what, we'll go ahead and move in to that state and live with you in that same unit, and now it becomes a primary residence for the parents. Or again, they can transition it into a 100% investment property at that point. The criteria is the same. The occupation from the time of purchase must remain the same for at least 12 months.
That I love this. Honestly, every time, and I know we're gonna close it out because we've
Yeah.
come to the hour mark, but there are so many opportunities. I think the point that we want to get across to the folks who are listening, who are taking advantage of this really education, this information, is that when you talk to us, there may be affiliations, your situation currently that you are in, that you may not even be aware there are opportunities for you to be able to leverage your current situation to
Yep.
start buying more investment properties, or to even buy your first property. And we get that all the time. More people from states that it costs a lot more to get a primary property may be able to easily afford a property in a state like Georgia. So we see
Oh yeah.
this constantly. So these are all great avenues for you to be able to take advantage of these particular products. So again, I know we're at
Yeah.
the top of the hour, so we'll close it out. I know we have some information about how you can get in touch with us. That is our information for the Maison Partners. And the next slide is how you can get in touch with Leo. Of course, feel free to connect with us. And we, of course, are going to be happy to discuss your particular situation because, again, it's all dependent on what your particular situation is at the time. And we're more than happy to try to find those opportunities for you that you may not have known are even available.
And
Yes, I
just to
want
kind
to
of, oh.
go ahead, Kirsten. Sorry, go
I
ahead.
was going to say, just to kind of tie in everything, as we've spoken this whole time, in terms of wealth building, real estate is one of the safest investments. Also, if you look at all of the, the billionaires in the United States, most of them have extensive real estate portfolios. And so people who are wealthy see the advantages of owning real estate and leveraging that as an investment. And finally, it's the only thing, land is the only thing that we're not making more of. So there's only a finite amount of land. So that's one of the things that makes it so valuable. So, Leo, I'm sorry.
Yeah. Yeah, no, you hit it on the dime because I was going to say exactly what you just said in closing. But I'm going to piggyback off of that really quick. So I know the numbers obviously on this end of it, and 95% of the billionaires and millionaires that we currently have actually started their wealth building from real estate. They have started it from real estate. And then obviously once they made a certain amount of money, investments went everywhere else. And I am gonna dare to say, with the exception of, Mr. Bezos and Mr. Musk, just because
The
those
tech
two,
folks.
yeah, those two have utilized the tech more than anything to build their wealth. But every other billionaire and millionaire that we know of has actually started in real estate. Real estate is what we considered a class A asset. It's a class A asset that will always be there. It will always be there. It has always been there, will always be there. You just have to time it, and that's the trick. It's just timing it. But that's a class A investment that will always be there. And that's what we utilize, and that's why we're here doing these presentations.
Okay, so thank you everyone for joining us. And just so you know, we will have the recording of this session. So do not fear if you missed it in person or you missed it live. We will always be able to go back and see all the pearls of wisdom that were shared today. So again, looking forward to doing this again, Leo. It's been great. And looking forward to talking and connecting with all of you, whether you're on demand webinar or you're live. Cannot wait to connect with you. Thanks, everyone.
Thank you guys. Appreciate you guys.
Bye.
Self-wealth.
Thank
Self-wealth
you.
and health to everyone.
Yeah. All right. Bye, everyone.
Bye-bye.